Most people want high returns. They want their money to grow fast. They want to see big gains, and they want it without stress. But here's the problem. In investing, those things don't come together. You can't have high returns without accepting risk. In the previous video, we talked about asset allocation, how capital is distributed. But behind every allocation decision, there is something deeper, a rule that governs every investment. Risk and return are always connected, and once you understand this, everything about investing starts to make sense. Everyone wants higher returns. That's natural. But what most people don't realize is that returns are not random. They are a reward, and specifically, a reward for taking risk. If there was no uncertainty, no volatility, no chance of loss, there would be no reason for higher returns to exist. This is where many beginners get confused. They believe there is a way to earn more without risking more. But in reality, that option simply does not exist. Why would anyone offer you high returns with no downside? If something is truly safe, everyone would invest in it. And as more people invest, returns would naturally go down. So the only reason high returns exist is because something could go wrong. Uncertainty creates opportunity, and risk is what makes returns possible. This is not a flaw in the system. It is the system. Every investment exists on a spectrum. On one side, safety; on the other, growth. Safe assets protect your money, but don't grow it much. Risky assets can grow your capital, but they can also decline. This relationship is called the risk-return trade-off, and it's one of the most important ideas in all of investing. You are always choosing a position on this spectrum, whether you realize it or not. Take cash as an example. It's stable, predictable, easy to understand. But over time, it barely grows. In fact, due to inflation, it can actually lose value. Now compare that to stocks. Stocks can increase significantly over time, but they also fluctuate, sometimes dramatically. This is the difference. Low risk comes with low return. Now let's look at the other side. High return investments always involve uncertainty. Stock markets can drop. Real estate can stagnate. Even entire economies can slow down. This uncertainty is not a problem. It's the reason returns exist. Because without risk, there would be no reward. And this is something every investor must accept. This is where most beginners make mistakes. They focus only on the upside. They see potential returns, but ignore the risk behind them. They invest in assets without understanding volatility. And when the market moves against them, they panic. They sell too early, or they enter at the worst possible moment. Not because the investment was wrong, but because they didn't understand the risk. Professional investors approach this differently. They don't start with the question, how much can I make? Instead, they ask, how much risk am I taking? Because they understand something critical. Return is unpredictable. Risk can be managed, and controlling risk is what creates long-term success. This is a fundamental shift in thinking. You don't start with returns, you start with risk. You define how much volatility you can handle, how much loss you can tolerate, and only then do you choose investments. Because once risk is defined, return becomes a result. Every portfolio is built on one core principle: not chasing the highest return, but balancing risk and reward. Because if you take too little risk, your money simply doesn't grow. It stays almost the same. And over time, inflation slowly reduces its value. But if you take too much risk, your portfolio becomes unstable. Large swings, unpredictable outcomes, emotional pressure, and that often leads to bad decisions. This is why investing is not about extremes. It's not about maximum return, and it's not about zero risk. It's about finding the balance between the two, a level of risk that allows growth without creating chaos in your portfolio. This is where real investing begins. Not in picking stocks, not in trying to predict the market, but in understanding how risk actually works. Because once you understand risk, you stop reacting to the market and start building a system. A system where every decision has a purpose, every asset has a role, and every risk is taken intentionally. This is the difference between random investing and structured investing. One is based on emotion, the other is based on control. And long-term success always comes from control. Not all investments carry the same type of risk, and that's important. Stocks can be volatile, they move quickly, sometimes unpredictably. Bonds are usually more stable, but offer lower returns. Real estate behaves differently. It's influenced by interest rates, economic cycles, and local markets. Commodities react to global events, supply, demand, geopolitics. Each asset responds to different forces, and because of that, they don't all move the same way at the same time. This difference between assets creates a powerful opportunity. Instead of relying on one investment, investors combine several, not to increase complexity, but to reduce overall risk. Because when one asset goes down, another may stay stable or even increase. This is how portfolios become more resilient, not by avoiding risk completely, but by spreading it intelligently. This concept is called diversification, and it's one of the most important ideas in portfolio construction. But diversification is often misunderstood. It's not about owning many assets. It's about owning the right combination of assets, assets that behave differently. Because if everything in your portfolio moves in the same direction, you are not diversified. You are just concentrated in multiple forms. True diversification happens when assets respond differently to the same situation. That's what reduces risk, not quantity, but structure. The goal of investing is not to eliminate risk. That's impossible. Every investment carries some level of uncertainty. The real goal is to take the right level of risk, a level that matches your strategy, your time horizon, your tolerance for volatility. Too little risk and your wealth doesn't grow. Too much risk and your strategy becomes unstable. The right level of risk is what allows consistency, and consistency is what builds long-term wealth. In investing, nothing is free. Every return comes with a cost, and that cost is risk. You are always being paid for the level of uncertainty you accept, no more, no less. And once you understand this, your entire perspective changes. You stop chasing returns and start asking a different question. How can I manage risk more intelligently? Because here's the key idea. Risk doesn't have to be eliminated, but it can be reduced. And that's exactly what professional investors do. They don't rely on a single asset. They build portfolios designed to balance and distribute risk. This is called diversification. And in the next episode, we'll break down how diversification actually works and how investors use it to reduce risk without sacrificing returns.